A $1.7 billion withdrawal from the backbone of dollar-pegged crypto liquidity has traders and institutions asking the same question. Where did it go, and why now? Over a single 7-day window, USDC's circulating supply shrank by that exact amount, net redemptions outpacing new issuance, a rare and significant outflow for the second-largest stablecoin. This isn't a glitch or a depeg scare. It's a deliberate movement of capital back into fiat, and it's triggering scrutiny over where stablecoin demand is really headed. USDC, issued by Circle, is designed to be a seamless bridge between traditional finance and on-chain activity. But when billions flow out in a week, it forces a closer look at who's redeeming, why they're doing it, and what it means for liquidity across exchanges, DeFi protocols, and institutional portfolios. The data comes from publicly available stablecoin tracking dashboards, which monitor minting and burning activity across Ethereum, Solana, and other supported blockchains. These figures aren't estimates, they're on-chain facts. A $1.7 billion USDC supply drop in 1 week is notable not just for its size, but for what it implies. More people wanted dollars than digital tokens. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. That kind of shift doesn't happen without a reason. It could be firms rebalancing portfolios, traders exiting positions, or institutions pulling back exposure. The pattern mirrors recent moves by companies like Bitdeer, which sold Bitcoin holdings for cash, signaling strategic shifts in how crypto-adjacent firms manage their balance sheets. But unlike a single company's decision, a stablecoin outflow ripples across the entire ecosystem. When USDC is redeemed, it's burned, removed from circulation. That reduces the amount of dollar-denominated capital available for trading, lending, and yield strategies across DeFi. It's not about price, it's about availability. Stablecoin outflows matter because they directly affect on-chain liquidity. When USDC is redeemed, it's burned, removed from circulation. That reduces the amount of dollar-denominated capital available for trading, lending, and yield strategies across DeFi. For traders, less USDC means tighter spreads, lower leverage, and potentially slower market action. It's not about price, it's about availability. USDC is engineered to maintain its $1 peg, and there's no indication that it's under stress. But the supply contraction speaks to demand, and demand is shifting. The important part isn't just the redemption, it's what it reveals about institutional behavior. The real question now is whether this USDC supply drop reflects a broader crypto liquidity shift. Are institutions pulling back? Are traders sitting on the sidelines? Or is this just a normal correction after a period of expansion? The next few weeks of on-chain activity will tell. Watch the burn rates, track new issuance, and compare trends across USDC, USDT, and other major stablecoins. A sustained contraction would signal tightening liquidity, a headwind for trading volumes and DeFi activity. But if issuance picks up again, it could mean this was just a blip. One thing is certain. The stability of the peg isn't in question, but the stability of demand is. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. The next signal to watch, whether Circle's upcoming transparency report shows reserves shrinking in line with supply, and whether competing chains see a surge in USDC minting that offsets the outflows. That's how you'll know if this is a rotation or a retreat. Watch the burn rates, track new issuance, and compare trends across USDC, USDT, and other major stablecoins. A sustained contraction would signal tightening liquidity, a headwind for trading volumes and DeFi activity. But if issuance picks up again, it could mean this was just a blip. The USDC supply drop is more than a number. It's a fingerprint of capital movement, and right now, it's pointing toward caution.